You scroll through your feed and see another 20-something billionaire minted overnight. The media bombards us with these pristine, frictionless narratives of explosive wealth creation, selling the illusion that massive financial success is a sudden lottery ticket rather than a grueling marathon. This overnight success myth is not just a harmless exaggeration. It is a toxic financial hazard that distorts your expectations, encourages reckless speculation, and fundamentally sabotages your ability to build lasting, scalable wealth. We need to completely dismantle this fantasy right now. When you study the actual mechanics of wealth accumulation, you realize that the sudden breakthrough you see on the cover of a magazine is merely the visible tip of a massive, submerged iceberg of failure, rejection, and relentless iteration. True financial mastery requires understanding that the foundation of an empire is poured in the dark, during years of invisible, unglamorous struggle that the press never bothered to document. To navigate this reality, you must treat resilience not just as a psychological trait, but as a tangible financial asset. In the world of aggressive growth and entrepreneurial ventures, your capacity to absorb losses, pivot your business model, and endure lean years directly dictates your ultimate valuation. According to research from the Harvard Business School, founders who have previously failed have a significantly higher chance of success in their subsequent ventures compared to first-time entrepreneurs, proving that early setbacks are actually mandatory data-gathering missions. Yet, knowing this academically is vastly different from surviving it financially. When your initial capital is bleeding out and your primary product faces market apathy, the temptation to abandon the venture and return to a safe linear income stream becomes overwhelming. That critical juncture is where the amateur folds and the strategic wealth builder doubles down, leveraging the very friction that destroyed their competitors to forge a sharper, more dominant market position. This brings us to the mechanics of the pivot, the defining maneuver of modern entrepreneurial resilience. A strategic pivot occurs when a founder analyzes market feedback, recognizes a fundamental flaw in their original thesis, and aggressively redirects their resources toward a more viable, scalable opportunity. It requires checking your ego at the door, ruthlessly cutting losses, and reallocating capital with surgical precision before your financial runway completely evaporates. Look at the brutal reality behind one of the most famous self-made billionaires of our generation, Sara Blakely. The narrative often skips straight to her massive success with Spanx, painting a picture of an instant retail phenomenon that disrupted the global apparel industry. But that glossy summary completely erases the grueling foundational years spent selling fax machines door to door, a period defined by daily rejections, slammed doors, and constant psychological attrition. Blakely took $5,000 of her personal savings and spent 2 agonizing years researching patents, scouting hosiery mills, and facing an endless wall of dismissive male executives who laughed at her prototype. She did not have venture capital backing, a sophisticated marketing team, or a safety net. She had an unyielding belief in a market gap and the sheer grit to bootstrap her vision into existence. Bootstrapping, the practice of funding a company through internal cash flow and personal finances rather than outside investment, forces a discipline that bloated, overfunded startups rarely develop. That relentless, unglamorous grind eventually forced a breakthrough when a buyer at a major department store finally gave her a chance. The discipline forged in those early desperate days fueled an audacious expansion, allowing her to retain 100% ownership of her company as it scaled into a billion-dollar empire. Her journey proves that the most lucrative equity you can hold is the ownership you protect by surviving the hardest, earliest phases of your business without selling out to the first investor who offers you a lifeline. We must internalize that the struggle is not an interruption of the wealth-building process. It is the process itself. Every rejection, every failed marketing campaign, and every supply chain breakdown is stress testing your business model, exposing vulnerabilities that would otherwise destroy you at scale. If you bypass this crucible, you build a fragile financial structure that will inevitably collapse under the weight of real market volatility. When you embrace this reality, your entire approach to risk management transforms. You stop looking for shortcuts and start engineering financial runways, which are reserves of liquid capital designed specifically to sustain your operations through the inevitable valleys of the entrepreneurial cycle. A robust financial runway gives you the ultimate luxury in business: the time required to let your strategic pivots take root and compound without the crushing pressure of immediate insolvency. The danger of ignoring this need for a runway is vividly illustrated when we examine the early career of Elon Musk. Today, he is synonymous with astronomical wealth and futuristic innovation, but the timeline leading to his current dominance is littered with near-catastrophic failures and moments of profound financial peril. His first major venture, Zip2, involved sleeping in the office and showering at a local community center because he could not afford an apartment, a stark contrast to the billionaire lifestyle we associate with him now. Even after successfully exiting that first company, the journey did not become a smooth upward trajectory. He poured his capital into the venture that eventually became PayPal, a transition fraught with internal power struggles, executive coups, and severe technological hurdles that threatened to bankrupt the entire enterprise. The survival of that payment platform was not guaranteed by visionary genius alone, but by a ruthless willingness to adapt the product architecture and the business model in real time to survive a hostile digital frontier. The echoes of those challenging market conditions followed him into his subsequent, far more ambitious projects. By 2008, both of his major manufacturing and aerospace companies were simultaneously teetering on the edge of total collapse, bleeding cash during one of the worst macroeconomic downturns in modern history. Musk famously had to divide his last remaining personal funds between the two companies, facing the very real mathematical probability that both would fail, leaving him completely wiped out after a decade of relentless labor. It was only through last-minute high-stakes contract wins and desperate financing rounds that these companies survived the brink. That terrifying proximity to ruin is the hidden cost of aggressive growth. It is the toll exacted by markets that demand absolute conviction before they yield generational wealth. The eventual triumph of those entities was born directly from an almost irrational level of entrepreneurial resilience, proving that surviving the absolute bottom is the prerequisite for reaching the apex. This brings us to a crucial realization about how broader market dynamics operate. Markets do not simply reward good ideas. They reward execution that survives the test of time, competition, and macroeconomic shocks. According to a comprehensive study by the Kauffman Foundation, the vast majority of successful, fast-growing companies experience multiple periods of severe stagnation or decline before they ever achieve exponential scale. Therefore, your wealth-building strategy must be inherently defensive as well as offensive. Asset allocation, the strategy of dividing your investment portfolio across different asset categories like stocks, bonds, and cash, is just as critical for an entrepreneur as it is for a passive investor. You must aggressively protect your downside, ensuring that a single catastrophic failure in one venture does not permanently annihilate your total net worth or your ability to play the game again. When you master this balance of aggressive ambition and calculated risk mitigation, you unlock a highly scalable income stream. You transition from trading your time for money to building systems, brands, and equity that generate value independently of your daily labor. But that transition is a brutal, uphill climb that requires you to absorb immense amounts of stress, uncertainty, and financial volatility without losing your strategic focus. Consider the psychological toll of watching your peers enjoy steady, comfortable salaries while you are reinvesting every spare cent into a venture that might not yield a return for half a decade. The isolation of the entrepreneurial path is one of its most formidable barriers, weeding out those who require constant external validation and immediate financial gratification. You will face moments where the market seems entirely indifferent to your innovation, where your cash flow is negative, and where the logical choice is to surrender. That exact moment of despair is where the true wealth creators separate themselves from the tourists. Instead of retreating, they analyze the data, recalibrate their offerings, and attack the problem from a completely new angle, utilizing the lessons extracted from their initial failure. This iterative process of testing, failing, learning, and redeploying capital is the actual unglamorous engine of wealth creation that the overnight success myth actively tries to conceal on a macroeconomic level. This resilient iteration is what drives entire industries forward. The companies that survive the initial brutal years become the foundational pillars of the economy, creating jobs, driving technological advancement, and generating massive returns for those who held equity through the darkest periods. The wealth generated by these entities is not a lucky windfall. It is the delayed compounded compensation for enduring years of concentrated risk and relentless problem solving. We must redefine how we view failure in the context of personal finance and wealth accumulation. A failed business venture, a poorly timed investment, or a rejected product launch should not be viewed as a permanent mark of incompetence, but as the tuition paid to the market for an advanced education in reality. The most sophisticated investors and entrepreneurs in the world have all paid this tuition, often multiple times, before they ever achieved a significant liquidity event. To apply this to your own life, you must audit your current financial resilience. Do you have the cash reserves to survive a 6-month disruption in your income? Are your investments diversified enough to withstand a severe market correction? If you're building a business, have you stress-tested your revenue model against the possibility of losing your largest client or facing a sudden spike in operational costs? These are not pessimistic questions. They are the strategic imperatives of a dominant wealth builder. If you only plan for the best-case scenario, you're leaving your financial destiny entirely to chance, exposing yourself to ruin the moment the market deviates from your optimistic projections. True confidence is not the belief that you will never fail. It is the absolute certainty that you have the systems, the capital, and the psychological fortitude to survive the failure and rebuild stronger. As you progress on this journey, the compounding effects of your resilience will begin to manifest in incredible ways. The network you build, the skills you acquire, and the equity you accumulate during the hardest years will suddenly align, creating a momentum that looks to the outside observer exactly like overnight success. But you will know the truth. You will know the exact price you paid in sweat capital and sleepless nights to engineer that seemingly effortless breakthrough. The path to extraordinary wealth is open to anyone willing to abandon the fairy tale and embrace the brutal, beautiful reality of the grind. Stop looking for the secret hack, the hidden stock tip, or the effortless shortcut, because they do not exist. Arm yourself with strategic financial knowledge, build an unbreakable, resilient mindset, and step into the arena ready to endure, adapt, and ultimately conquer the long, rewarding game of generational wealth creation.